appendix and kind of look at the calculus version of kind of what we've learned so far in this chapter. Choosing taxes, this section is called. And so imagine there's two political parties. Imagine two different political parties, different political parties that are proposing different taxes to raise revenue. So party A, so political party A is saying, well, let's use a quantity tax. So remember the quantity tax from back in chapter 2, we learned about the budget constraint, that's what we're talking about. And then party B, they want to just do an income tax. And the kind of question here is, which tax is better at raising revenue? So let's start off by looking at the quantity tax. So if you remember from way back in chapter 2, when we had a quantity tax, it was the price of good one plus T, we're going to put the quantity tax on good one, times the amount of X1. So every time you buy a unit of good one, you have to pay T dollars. So it's like those excise taxes, plus P2 X2 equals M. So we don't know whether this tax increases or decreases the amount of good one, though we can probably, it's likely going to decrease. Only in kind of certain cases where we actually see an increase of it, but it's likely going to decrease. If we put a tax on something, it's likely going to cause us to have less of it. Now we can think about the revenue from doing this tax. We're going to call R. We're going to call R star, and it's going to be the amount of this quantity tax times the optimal amount that this individual is going to consume. So this is what a quantity tax would look like. It's a quantity tax on good one. This is the amount of revenue they're going to get. The size of the tax times however much we're buying of good one, or how much this individual is buying of good one. All right, now let's turn ourselves, let's go to income taxes and think about what that would look like. And we're going to think about, well, an income tax that's going to needs to raise the same amount of money. And so basically it'd be an income tax of exactly T times X1 star. That would exactly be the size of the income tax, so we can raise the same amount of money. So let's quickly erase this and conceptually think about how to represent this. And so to raise the same revenue, we would need to have an income tax of exactly that R star that we calculated before, right? And then this would raise the same revenue as that quantity tax before. But we kind of already talked about this. R star equals T times X1 star. Right? That's what it was before when we had the quantity tax. And so P1 X1 plus P2 X2 equals M minus T times X1 star. Notice this budget constraint has the same slope as the original budget constraint. Remember, putting a quantity tax on good one would change the effective price of good one. And so with a quantity tax, the budget constraint for that quantity tax does not have the same slope as the original budget constraint. It has a steeper slope. because the price of good one is effectively higher. So the first thing that we should notice is this line passes through X1 star, X2 star. So that optimal bundle that they were picking under the quantity tax, it must pass through there. And you can see that because, you know, if we thought back to what I just erased, like this is essentially, if we rearrange this line, we'd get the exact same thing, right? So X1 star, X2 star is affordable. We could afford to have that. Because again, we could rearrange this to get exactly what we got before with a quantity tax. So this is definitely an affordable bundle, but is it optimal? Is it optimal? And the answer is going to be no. And so let's kind of quickly erase this and we'll draw kind of a graphical representation of what's going on here and kind of logically think through why this income tax is actually going to be a better way. What the budget constraint and what this graphically looked like for this quantity tax. And we're going to kind of talk our way through why the income tax is better. All right, so let's just draw out the amount of X2, so amount of good 2, amount of good 1. Let's say this is the original budget constraint. We had some original optimal quantity. So this kind of yellow-green color is the original. So, well, let's say this is the original budget for any of the taxes, and this was the original optimum. And then what happens, we had this, first thing we looked at is this quantity tax. And let's say it looks something like that. Remember, it's changing the slope of this line because there's a tax on good 1. So the effective price of good 1 has gone up, and so we have that, it rotates in, so to speak. So then let's draw the optimal choice under this tax. Let's say our indifference curves look something like that, and let's say this point right here is what we called X1 star and X2 star, the optimal choices under this quantity tax. And remember, R star was equal to the tax times how much a good 1 we had. Okay, now what we want to do for the income tax is draw a line it's going to be hard for me freehand, but a parallel line to this original budget constraint. It just shifted in by exactly what this revenue was for the tax. And so I'm going to use orange for this one, and it's supposed to have the same slope as this, but knowing me, it's going to be a little bit of a struggle, and I'm going to draw in a particular way that notice that I draw passing through this X1, X2 star. That's because of what I just said before, that this X1 star and X2 star is along this line. And I kind of talked about how we can rewrite that new budget constraint so it's exactly what the budget constraint was, or what point along the budget constraint, the optimal point along the budget constraint are when we have a quantity tax. So that's why this new budget constraint has the same slope as the original, and it passes through X1 and X2 star. But notice that the slope of the difference curve or the budget constraint at this optimal point is different, in the sense that at X1 star, X2 star, at this optimal point under the quantity tax, the marginal rate of substitution is, you know, minus P1 plus the tax over P2, right? That's the slope of this original indifference curve, or sorry, not the original indifference curve, but the original curve, the indifference curve that gives us the optimal under this quantity tax. So that's the slope of this original one, but notice that this line, the income tax passes through it. So, but income tax has a marginal rate of substitution, or the slope of this line, the price ratio, has a marginal rate of substitution it's smaller, right? We have a tax here, we don't here, so the difference is this T. And so this number is different than this number, which means there needs to be another point somewhere nearby x1, x2 star that's on a higher indifference curve that this person can still afford. And so that's like something like this. It's getting a bit messy now, where this is the optimal decision, optimal bundle with the income tax. So with the income tax, they could afford to have x1 star and x2 star, but they can do better than that. They can, you know, increase their x1 a bit in this case and have a bit less x2, and they can be better off than they were under their quantity tax. And so because these are different, it's basically saying that this line is crossing through x1, x2 star. It's not tangent. It's crossing through this budget concern of the income tax crosses through this, this indifference curve that gave us the optimal amount under the quantity tax. So this is the preferred bundle, and this bundle is on a higher indifference curve than this, than the quantity tax, so the income tax is preferred. Hopefully you can kind of follow the logic that I was trying to give you there. Okay, a couple caveats about this. About this analysis here, because we made some generalization. It was, first of all, it was only for one person. And so, different consumers are going to end up having different revenues based on their choices of how much they have, right? So we can't really generalize, and in general, income taxes are always preferred. It's just like when we look at one consumer, it's preferred because we can actually equate these revenues, right? Two is that we have assumed that income hasn't changed. Have assumed M doesn't change from the tax, from the income tax. But if you were taxed on your income, and every hour you worked you had to pay a certain amount of tax, that might affect how many hours you work, which affects your income. We kind of abstracted from that here. So in labor economics, we'd be very interested in how taxes on labor affect how much people want to work, or their labor force participation in general. And finally, the third caveat is we've left out the supply response to this. In the sense that we're really only looking at half the picture about how this is affecting one consumer's demand. But I mean, there's a whole other side. We have demand, we also have supply. We're kind of like abstracting from that, right? But anyway, even with kind of like what we've learned so far in this chapter, we could say something interesting like this, where the income taxes are a better way to raise money in this particular case than a quantity tax.